Greetings and salutations. This is your local friendly mortgage guy, owner of Chariot Financial, Zach Smith, uh, hopping on here, going live for our reverse mortgage weekly that we do every single week. I'm a little late and I apologize for that, but let's go ahead and get started. Wonderful program that we love sharing about the reverse mortgage. Let's hop right into it since I'm coming in a little late here. So, who is Chariot Financial? Who are these guys at Chariot Financial? Who are they, anyways? Well, that's me. I'm trying to do my best impression of the Karate Kid there. I own Chariot Financial. I've been doing this for 21 years. I'm a CSA, a BBB accredited business, and I am here at your service to answer any questions about mortgage products. I will also do astrology readings and tarot readings. No, I'm just kidding. Unless you're really interested, then I will. But this whole rest of this 20 minutes is going to be dedicated towards the program of the reverse mortgage, which is great. And the reason I'm doing these is that there's a lot of information out there about the reverse mortgage. A lot of it's not great, and a lot of it's just not accurate, and we'll go over some of this information as well through the presentation here. So what are we going to go over? Well, we're going to go over what typical clients, what we see for a reverse mortgage, what a reverse mortgage is, what a reverse mortgage is not, why people are choosing a reverse mortgage, and how they work in simple terms. So who are typical clients that we see? Well, we see older adults that are looking for an increase in cash flow, older adults that need relief from higher monthly payments like a mortgage loan. In fact, a lot of our loans are basically replacing the first mortgage with a reverse mortgage. And what that does is it creates a payment optional situation, whereas before you have to make a monthly payment on your reverse or on your forward mortgage. Well, all of a sudden overnight, if you have a $1,500 payment, principal and interest, and all of a sudden you don't have to pay that any longer, well, you just gave yourself a $1,500 a month raise. Now, yes, you are paying it with your equity. It's going on the top of the loan. It's going on the back. But would you rather have that cash in your pocket right now, or would you rather be handing it over to the bank? And this is a silly thing about handing it over to the bank. They're not even going to put that $1,500 all against the loan. They're going to keep most of it in interest. On a 30-year fix, let's say you just refinance the property and you have a 30-year fixed and you're making a monthly payment. Well, only a fraction of that payment is going to go towards paying things off. So something to keep in mind when we're looking at mortgage financing. Would you rather have that money in your pocket, or would you rather give it to the bank? Is really the situation. And of course, again, it's going on top of the loan. But right now, in this moment, what's more important to you? It's kind of like, a bottle of water. You have a bottle of water, you go to the store, you can buy it for 88 cents, in a big package. I know we're not supposed to buy those anymore. They're bad for the environment. But you can buy it for 88 cents at the store. You go to the movie theater and they'll charge you $3. Well, you would think to yourself, well, no one's going to buy water at the movie theater for $3. No way. No way someone's going to pay $3 for water. It's not the case. People buy it all day long. It's all about what's more valuable. It's the conversation of cost versus value. So we work with people who are looking to try and alleviate some of the debt and really increase their cash flow is what the name of the game is. So by eliminating credit card debt, car payments, things like that, people can increase their cash flow. And then, the other folks that we work with are, folks who own their home free and clear. They're very affluent, and they like to open up the line of credits, to cover unforeseen costs, as well as instead of withdrawing from their retirement accounts, well, they withdraw from their mortgage, and guess how much they get taxed on that? Zero tax on that. So what a reverse mortgage is, a reverse mortgage loan, it's a loan. It does have monthly payments, but those payments are optional. It's generally with a line of credit, cash payout, or tenured payment payout over time. What a reverse mortgage is not. Despite what your uncle tells you, it's not a government takeover of your home. The government doesn't want your house. It's not profitable for them, and it's not something that they are wanting to do. It's not a way to make you go upside down on your property. You'll have folks talking about the reverse mortgage, and one of the scare tactics that they'll use is, oh, the bank wants you to go upside down on your house so you won't have any equity. Well, guess who loses in that situation? Guess who doesn't get to make a profit in that situation the way they want to? The bank. So the notion that the bank wants you to go upside down is pretty silly, because that's bad for the bank. If they have an asset that they owe way more on than what it's worth, that doesn't make sense. The banks have gotten very good at making a profit, and they're making profit off of interest. They're not making profit off of real estate that doesn't appraise for what they owe on it. It's not like they sit in their conference every, when they have their meetings, and they sit down, and the president of the bank is looking at all the executives, say, you know what, let's find out how we can give away more money today. I want to make sure that we're working on a way to lose profits today. Doesn't work that way. So, folks, there's a lot of bad information out there about the reverse mortgage program. It's not a payment-free mortgage. Now, that's something that is important, that I don't know that a lot of my industry does a good job at explaining. There is a monthly payment on a reverse mortgage. In fact, you can make the monthly payment if you want. Treat it just like any other mortgage. Pay it off early. But the only difference between the monthly payment on a reverse mortgage and a monthly payment on a normal mortgage is that the reverse mortgage, it's optional. And most people decide not to make that payment, especially when they do the math and they see that their payment is going right to the bank, not to paying off their principal. So why are folks choosing these programs in retirement? Why are these so popular right now? Well, I think it's to me, it's pretty simple. I mean, it's based on liquidity and long-term financial planning. Those are really the two main reasons people are taking these out. So let's talk about home equity and liquidity. Equity is great to have, but unfortunately, it's not liquid. So it's not like, we have a glass coffee table. Equity is a lot like having a glass coffee table right there in the middle of your living room, full of cash that you can't get to. So, you're sitting down on the couch and you're getting ready to watch your favorite show. Personally, I haven't been watching any of the news programs lately, so I've been going through all the Seinfeld episodes, which is kind of fun because it's light and it's a lot. I'll tell you, it's a lot less stressful than watching the news. I can tell you that much. So, you sit down, putting on an episode of Seinfeld or whatever, put your feet up on the coffee table there, and you got all that cash there. Oh, look at all that cash, but it doesn't really do you any good. Because you can't get to it. So, it's not like you can take a picture of your house and go down to the grocery store and pay for your groceries with it. That's not how it works. So, basically, that becomes an issue with retirees, because most retirees are on a fixed income and they have limited cash flow. Most people do not want to work into their 60s and 70s and 80s. And unforeseen medical expenses can liquidate retirement assets prematurely. So the reverse mortgage solves the problem of liquidity. The reverse mortgage is designed to help older adults access equity when they need it, either by establishing a line of credit, a cash payout, or converting the existing mortgage payment into a payment optional reverse. So the reverse mortgage as a financial planning tool. So, some Americans are living longer, which creates a lot of concern about running out of retirement assets that they're going to leave to their heirs, or if they're going to be able to live off of them. Is their nest egg going to outlast them? or are they going to outlast their nest egg? It's a huge, huge problem right now. So, the research of Harold Ivinsky, Sean Pfeiffer, and John Salter of Texas Tech University, they published an article about the academic acceptance of the reverse mortgage product as it pertains to the survivability of one's assets when using home equity in their retirement plan. And, this is a big hot button right now with fiduciaries because people are thinking, well, look, with most people, their largest asset is their home equity. And fiduciaries are supposed to be talking and making decisions for their clients that are going to be in the best interest of their clients. So when fiduciaries talk about, do not talk about home equity, are they really doing the best thing for their client? Are they really taking into account everything about that client? Are they leaving no stone unturned? And in my opinion, no. Absolutely no. They are not doing their fiduciary job if they're not talking about their home equity in their financial planning. And most fiduciaries don't do it because they don't really know how. They don't really understand that there's a way, or they don't know how the reverse mortgage works, or they're hung up on the fees for the reverse mortgage as well. And that's something that, if you choose an FHA loan, there's not a whole lot we can do about that. They're pretty expensive. They're going to charge you 2% up front. So if you got a $500,000 home, they're going to charge you 10 grand at closing for the upfront mortgage insurance premium. Now, that's not a reverse mortgage thing. This is another thing that, the reverse mortgage gets a bad rap because of that. But the problem is that it's not a reverse mortgage thing. It's an FHA thing. So if you have a first-time home buyer or somebody who's, a couple of years out of a bankruptcy or a foreclosure or something like that, they have to do an FHA loan. And FHA will charge them that same amount, even if they're, just a first-time home buyer or something like that. So basically what the study, or what several studies have shown, is that if you incorporate your home equity into your retirement plan, well, guess what? Your nest egg is going to last a lot longer. The survivability rate in every single one of these tests and trials basically shows that if you use home equity, it's going to last a lot longer. It's going to have a much higher probability of success. Whereas if you do not use home equity, the rate of success is pretty low. So there's many different types of reverse mortgage loans. There's not just one. I mean, there's proprietary programs, there's FHA programs, all types of different reverse mortgage loans. The most popular one is a HECM. So what the heck is a HECM? Well, the term HECM is an acronym for Home Equity Conversion Mortgage. And it's the FHA's version of the reverse mortgage program, and the most common. HECM loans are administered by HUD and come with certain protections for the homeowner. These include non-recourse feature, bank failure security, increased access to funds and the line of credit over time. So a whole host of features that make it very desirable for older adults because there are a lot of safety features involved. And the interest rates are much lower on these programs too. So in my opinion, it is superior to a lot of the other programs, and it's something that we look at for most folks. Well, we know who this fella is. This is our buddy Tom Selleck and his legendary mustache. And he's out there with one of our partners, actually, AAG. We're signed up with them. We don't do a whole lot of business through AAG. We like to use Mutual of Omaha and Longbridge for our reverse mortgages. We also have a great relationship with SmartFi and some other folks that have some really good products. But Mutual of Omaha has been our mainstay for some time now. But we look at them all. My goal is to get people the best possible rate, best possible program. So we look at all of them, but we get special pricing with some of our lenders, so or they offer us special pricing. So we will usually go with them because they're going to be a better deal for our clients. Well, he was quoted as saying the reverse mortgage loan is just like any other loan. The only difference is how you pay it back. And old Tom Selleck hit the nail right on the head there, because it's true. It is just like any other loan. You can treat it just like any other loan. So why is it called a reverse mortgage if it's just like any other loan? Well, the reverse mortgage is still a mortgage. Surprise, surprise, surprise. It's still a mortgage. It does have a monthly payment, but this payment is optional. So that's one of the things that makes this loan really attractive to retirees. And you have to be of age 55 plus to do a reverse mortgage. So that's one thing that makes it very attractive, is that it is an optional payment. So, if you choose not to make the monthly payment, the balance will grow every month. So taxes and insurance will need to be paid separately in most cases. So the two biggest myths about the reverse mortgage that I see in my line of work is that you'll be upside down on your home within a few years, that couldn't be further from the truth. Again, like we explained earlier in the presentation, if you go upside down on your property, the bank is going to lose. The bank just lost. In fact, a lot of their risk assessment is based on you not going upside down. They do not want a real estate asset on their books that they can't sell for what they owe on it. It's not good business. It's not what they're doing business for. The second thing that I hear is that you no longer have title to your house. Both of these are false, couldn't be further from the truth. So 3 ways to structure your reverse mortgage. So the most popular option is through a line of credit. The reason people like the line of credit is it has a built-in growth feature, so it's almost like having another savings account on the home. So basically, you put a line of credit on the property, it grows over time, and if you need the funds, they're there. If you don't need them, you don't need to take them. The other way is people can get a cash payment. So cash is basically just distributed at closing. A guy shows up with a suitcase full of cash. No, I'm just kidding. It doesn't happen that way, but but they can wire you funds at closing. Or people can set things up on what's called a tenured payment. And the tenured payment is basically like turning your house into an annuity where it will pay you back each month. Any questions? Okay, great. We'll move on. So how is the amount qualified? How is the qualified amount determined? Well, again, the risk factor on a normal mortgage, if you walk into the bank, and you say, hey, I want to buy a house. Can you lend me 400 grand? They'll say, oh, yeah, we'd love to. Actually, it's really hard to find mortgage people when you walk into the bank now. The industry has been reduced by 75%. Just a little fun fact. In the last 4 years, 75% of loan people are gone. I'm happy to say that Chariot Financial is still standing strong. We've made it through a really slow time last year, and was slow in the industry, but we actually thrived during that time. We're thriving now, mainly because we do business word of mouth, and we offer great rates and great products. And you know what? I actually care about what goes on with my clients and my business. And I've always felt if I operate from that space, you can't go wrong. And you know what? It feels good too. So you walk into the bank, you ask for 400 grand, and they come back to you and say, well, oh yeah, we'd love to lend you 400 grand. How are you going to pay us back? What kind of a credit risk are you? How are we going to get our money back plus our interest? And they want that interest, because with a forward mortgage, you're paying 50% of that interest in the first 10 years of the loan. So they want to make sure they're going to get their interest back. And the way they do that is they look at your income, they look at your assets, and they look at your credit. And then they make a judgment call and say, okay, this person is a good credit risk, let's lend them the money. Or this person is not a good credit risk, let's not lend them the money. Well, with a reverse mortgage, there's no required monthly payment. So how do you determine risk? Well, time. How long is the person going to be in the house? That's really where the risk lies. Because if one person is in the house for 10 years, the interest is going to accrue on 10 years. Well, what if the person's going to be in the house for 30 years? Well, the interest is going to accrue for 30 years. So the whole idea is that the bank does not want to go upside down, because then they have an asset that is that is owed more on than what it's actually worth. So again, the sentiment that the bank wants you to go upside down is just silly, and it doesn't make any sense. Um, so so time is really the factor that they determine reverse mortgage programs with. So for instance, someone who is 62 can borrow less than someone who is 82, because they're basically banking on the person that's 82 being in the house less time than the person that's 62, so they give them access to more equity. Well, that's all we got for you today. Feel free to give me a call anytime. I'm happy to help in any way, shape, or form. We are thriving this year in 2025, and I'm happy to be of service in any way, shape, or form. You can reach me anytime at chariotreverse.com, chariotreverse.com, chariotreverse.com. Once again, my name is Zach Smith, owner of Chariot Financial, and we are signing off for the day. Hope you have a good rest of your day. Thanks a lot for hanging out with me.